Welcome to KPMG's podcast to discuss the FASB's ASU on disclosures about offsetting assets and liabilities. My name is Danielle Imperial. I'm a senior manager in KPMG's Department of Professional Practice. This podcast was recorded on March 19, 2013, and for the next 5 minutes, I'll highlight some of the key disclosure requirements and the FASB's clarification on the scope of the disclosure requirements.
ASU 2011-11 was a result of a joint project conducted by the FASB and the IASB with the goal of convergence on its offsetting criteria. An ED was issued in January of 2011, which would have converged the offsetting models and resulted in more financial instruments being presented gross on the balance sheet for U.S. GAAP. However, during redeliberations, the boards decided on different offsetting approaches, resulting in the FASB leaving U.S. GAAP unchanged and the IASB addressing diversity in practice by adding application guidance to IAS 32. However, although the boards were unable to converge their offsetting models, they developed joint disclosures to improve current disclosure requirements and allow for greater comparability among US GAAP and IFRS financial statements. These new disclosure requirements were issued in the ASU 2011-11, which was issued in the fourth quarter of 2011, and the IASB issued similar disclosure requirements. After the ASU was issued, implementation issues were raised, which caused the issuance of ASU 2013-1. The ASU 2013-1 was a result of concerns by various constituents regarding the scope of the original ASU. Some constituents expressed concern that the scope would include short-term payables and receivables from customers and suppliers that were issued in the normal course of business where the right of offset exists. Additionally, broker-dealers were concerned that their trade receivables and payables, which were offset based on industry-specific guidance, would also be subject to the new disclosure requirements. If you move on to slide 2, the ASU indicates what the ASU 2013-1 clarifies. The scope of the new disclosure offsetting items will be limited to derivatives, including embedded derivatives, repurchase and reverse repurchase agreements, and securities borrowing and securities lending agreements that are either currently offset in the statement of financial position or which are subject to an enforceable master netting agreement or similar arrangement. Companies that are currently offsetting under ASC 210 or ASC 815, which are, for those of you who have not codified or your literature yet, it's the old FIN 39 and FIN 41, would be subject to the new disclosure requirements, as well as those subject to an enforceable master netting arrangement or similar agreement. Some examples of similar agreements include derivative clearing arrangements, global master repurchase agreements, and global master security lending agreements. Some instruments which are not included in the scope include loans and customer deposits at the same institution, financial instruments collateralized by non-financial collateral, such as loans collateralized by buildings. And these new disclosure requirements will affect all entities that have financial instruments that are either offset or are subject to a master netting agreement, not just financial institutions. Now, if you turn to slide 3, the effective date for these new disclosure requirements is annual periods beginning after January 1st, 2013, and interim periods within those annual periods. So for calendar year companies, the new disclosure requirements will be effective for March 31st. And the transition requirements will require retrospective application. If you move over to slide 4, it goes through the detailed disclosure requirements. So entities will be required to disclose either in a tabular format, which we'll illustrate on slide 7, or another format that an entity deems most appropriate, the following information. First, A, they'll be required to disclose the gross amount of in-scope recognized assets and liabilities. B, they'll be required to disclose amounts offset in accordance with offsetting criteria. Then they'll take those amounts and they'll disclose the net amount presented in the statement of financial position. D, they'll include amounts subject to offsetting which are not included in the B above. And then finally, they'll have the net amount. And these disclosures are required to be presented by type of financial instrument or transaction. However, the board will permit flexibility in terms of whether an entity wants to disclose A through C by type of financial instrument, and they could decide if they want to choose to disclose C through D by either financial instrument or counterparty. The board understood and permitted this flexibility because they understand preparers manage credit risk by counterparty and not by class of financial institution. In order for financial statement preparers to be able to provide this information, they may need to develop new procedures in order to capture the required information. Then if you look on slide 5 and 6, go into a little more detail regarding each of those items at A through E, which we discussed on slide 4, and I'll just highlight a couple of things. The gross amount, A, would equal the net amount presented on the financial statements when an entity has instruments that do not meet the offsetting criteria under the old FIN 39 and FIN 41, which is ASC 210 and ASC 815, codified in those guidance, or if management does not elect to offset. And a company is required to reconcile, C, the net amount presented in the statement of financial position, with the individual line items in the statement of financial position. In all the tables, just wanted to highlight that this table may have include financial instruments that are subject to different measurement attributes. For example, a payable related to a repurchase agreement may be measured at amortized cost, while a derivative is measured at fair value. The instruments are required to be included in the table at their recognized amount, and any resulting measurement difference should be disclosed. If you flip to slide 7, we'll just go through a brief example. Company A has a derivative asset with a fair value of 100 and a derivative liability with a fair value of 80 million with Bank B. Company A has also received $10 million of cash collateral. Company A's financial instruments and derivatives, including the collateral, are subject to a master netting agreement with Bank B, and the company elects to offset in accordance with ASC 815. We'll also assume that Company A has no other financial instruments that are subject to offsetting disclosures. So if you look at this table, it illustrates what Company A would be required to disclose. So Company A would show the gross amount of the derivative asset of 100, so that's column A. The amount offset in the balance sheet, so column B, would be both the derivative liability with the fair value of 80, as well as the cash collateral of 10, so it's offset of 90, column B. So the net amount presented in the financial statements would be C, which would be 10, which is shown in column C, and then no amounts would be disclosed in D, so the net amount in E is also the same as what we have in column C, which is 10. In addition to the quantitative disclosures, a company also has certain qualitative disclosures that it's required to disclose. An entity will be required to provide a description of the amounts of set-off rights included in item D, which we discussed, as well as the nature of those rights. For example, for conditional right of offset, an entity is to describe the conditions in which it may offset. Similarly, for collateral received or collateral pledged, an entity should describe the terms of the collateral. Entities would also need to assess whether there is any other supplemental additional qualitative disclosures which would help the readers evaluate if there's any right of offset.
That concludes KPMG's podcast on disclosures about offsetting assets and liabilities. You can find more information on the Financial Reporting Network, including our defining issues on this topic. Thank you for listening.